If you're doing backdoor Roth conversions, it's very important that you take into consideration this one tax rule that could really hurt your ability to convert into a Roth IRA. Hi, my name's Zach Morris, and today I want to talk to you about something called the Pro-Rata rule, which a lot of people don't know about, but it's very important to take into consideration if you're regularly doing backdoor Roths or it's something that you've looked at or considered doing. First, I want to walk through the different types of IRA transactions just so that we can build on our foundation here. And then we're going to get to the backdoor Roth conversion as well as the pro-rata rule. So first, let's talk about just a simple IRA contribution. In a traditional IRA contribution, the money goes in pre-tax or you get a tax deduction, right? So you put in $7,000 pre-tax, or it goes in from your checking account and then you deduct it from your taxes, which essentially makes it pre-tax. So all of the money in that traditional IRA is then pre-tax money. Okay. Now let's look at the example of a Roth contribution. So same $7,000 goes in from your checking account. It goes into a Roth IRA. There's no deduction there. It goes in after tax. And so now you have $7,000 worth of after-tax money in a Roth IRA. Now, with a backdoor Roth conversion, you're typically taking that same $7,000 contribution, and because you're unable to contribute directly to a Roth because you make too much money, and you can't make a deductible contribution to a traditional IRA because you're covered by work and or you make too much money, then you make a non-deductible contribution to a traditional IRA. So you make a non-deductible contribution to a traditional IRA, and now you have a traditional IRA that has after-tax money in it. So you never took a deduction, so it's after-tax money. Then you convert your traditional IRA to a Roth. That's how you're able to get money into a Roth IRA without paying any additional taxes than you've already paid, because you paid money on that income when you got it. When you got your W-2 income, it came into your checking account. It's after tax. You make that contribution to a traditional IRA, you don't take a deduction, still after tax. Then you convert it to a Roth IRA, and it's now after tax, and you're able to contribute to a Roth IRA even though your income was over the limit that allows you to contribute to a Roth IRA. So if you've been doing this, if you've been doing Roth contributions or backdoor Roth conversions, then you are already familiar with this strategy. Now, the next thing that I want to talk to you about is called the Pro-Rata rule. And not a lot of people are aware of this, but it's something to take into consideration when you're doing backdoor Roth conversions. If you have any pre-tax money in any IRA anywhere, it could be at you could have a traditional IRA with pre-tax money at Fidelity, and you could be trying to do a backdoor Roth conversion at Charles Schwab. If you do that backdoor Roth conversion, the pre-tax money will be counted in that conversion. Now, let me use an example here. Assume you have $93,000 worth of pre-tax money in a traditional IRA. Now, in an unrelated transaction, even in a different traditional IRA, you make a $7,000 contribution to a traditional IRA. Now, for sake of this example, let's say they're at two completely different institutions. $93,000 at Fidelity, $7,000 goes into a traditional IRA at Charles Schwab. That $7,000 that went into that traditional IRA, you did not take a deduction for. So you make a non-deductible contribution to that traditional IRA and attempt to do a backdoor Roth. Now, the pro-rata rule states that when you go to convert that $7,000, the IRS is going to assume that you're converting that amount pro rata. So all of your IRA assets equal $100,000, and $93,000 is pre-tax, $7,000 is after tax. So when you go to convert that $7,000 to a Roth IRA from that traditional at Charles Schwab to a Roth IRA, you're going to pay tax on 93% of that conversion. Take that into consideration when you go to do Roth conversions. It's important, especially backdoor Roth conversions, it's important that you know how much you have out there in traditional IRAs in pre-tax money, because that money is going to be counted when you go do that backdoor Roth. So in summary, for the pro-rata rule, it's important to take into consideration how many IRAs you have out there. And if you have pre-tax money out there in an IRA in some institution, you may not be able to get the same benefit of a backdoor Roth as if it was your first contribution into a traditional IRA. Feel free to also subscribe to our newsletter as well as the YouTube channel. Thank you for joining this video today.